Let's talk about why high interest rate environments are bad for stocks. You hear it all the time in the news, but I don't even think the newscasters really know why. They just repeat. Let's dive really deep into this subject. First, let's start by explaining the basic formula of WACC and then extrapolate this out into a wider picture, looking at it from a high touch perspective. Alright, in terms of WACC, this means weighted average cost of capital, and it's really important to understand this basic formula to understand why the rising interest rates are so bad for stocks. So let's say that you have a tech company in Silicon Valley and the balance sheet consists of 10% equity and 90% debt. In this case, the founders, the venture capitalists that put money in, they want to see a 10% return on their equity. So that's the cost of capital for equity. And then you have this 90% debt that's financed by corporate banking loans, obligations, etc. And you have a fluctuating rate, in this case of half a percentage point. You will find the cost of capital for this tech company by taking 0.1 times 10% and add that to 0.9 times half a percentage point. And let's say that you have a company where this cost of capital is 3%. Well, this means that you can undertake projects that generate a return of investment of 5%. And as long as you can get capital at the 3% rate, you can undertake so many different projects and they will be profitable. Investors will make a ton of money from this and shareholders will be really, really happy. And this is what we've seen in the times of low interest. Companies that have had access to a lot of cheap capital have utilized this and undertaken different projects with kind of a low return of investment, but hey, that's okay. Capital is so cheap. We can basically make infinite amounts of money on this as long as we have access to cheap capital. However, right now, with the rising interest rates, the chickens are coming home to roost. When they fluctuate, when the rates increase and the capital becomes more expensive, projects that once was generating a profit for shareholders are now losing the company money. And management will have a tough decision on what to do. They have a sunken cost. They have, invested money already in some cases. They can't undertake moonshot goals anymore. They have to cut back on experimental divisions, and it's not as profitable anymore to be a business when capital is expensive. And this is what we're seeing right now. We're seeing the layoffs and we're seeing companies focusing more on their core and less on innovation as a result of interest rates going up. Alright, so hopefully you found this content both educational and entertaining, and as always, I hope you make a ton of money, whatever investments you decide to make. Take care now. Bye bye.